Thanks for watching this week's Hot Property Online. My name is Christian Harris. With all sort of the banking changes and how it's more difficult to get money from a bank and government intervention, people it's really affected is the business for self. Revenue Canada, the government has basically told the banks you can only use their taxable income to qualify them, and that's upset a lot of our business for self clients. We love our business for self clients. We're all business for self in here. We understand it. I want to kind of walk through the math with you. Obviously, these clients now are being pushed from the banks into these alternative lenders at higher interest rates, and they're not liking it. But we got to look at the overall picture and what money we're really looking at here. The great thing about being business for self is you can deduct off your gross income a lot of expenses that salary people don't have the advantage of doing. The other thing is you can leave money in your holdco called retained earnings, that if you don't pull it out, they're taxed at a much lower than if you paid yourself that personally. So a lot of people leave money in retained earnings. And a typical call would be, well, I make $400,000 a year in my business, I pay myself, $50, and I have $200,000 in retained earnings. We have some expenses, but I got $200,000 sitting in my bank account. I'm a good client. But the bank's looking at what you pay yourself personally. They don't look at your retained earnings. So let's look at an example here on the board of a $500,000 mortgage, okay? And obviously, if we have to go to our alternative lender, you're going to be looking at kind of, 2 to 3% higher overall cost. Not 2 to 3% in rate. The rate may only be 1%, 1.25% higher than the bank's rate, but there's typically fees involved. So let's call it an overall borrowing cost of 3% higher by going with this alternative lender. What does that mean on a $500K mortgage? It means $905 a month, roughly just under $11,000 a year. That same example of the client who pays themselves $50, well, that's not going to qualify them for a $500K mortgage anymore in today's world. They're going to have to pay themselves more like $100, roughly, to qualify for $500 under today's guidelines. So they would have to increase their income by $50,000, which would mean on that $50,000, they're going to have to cut a check to Revenue Canada for $25,000. Here you go. I just had to pay myself an extra $50 that I needed to qualify with a bank, but it's going to cost me a check. I got to literally write the check to Revenue Canada for $25,000. Math is math. I'd rather have it cost me 11 than 25, A, and B, I don't want to write a check to them. I don't want to actually physically give them a check. This is just a monthly carrying cost that I can absorb because I do make the money. So I know no one wants to pay a higher rate. I've been doing this for 24 years and no one comes to me and say they want to pay a higher rate. But for the business itself, clientele, this is the new reality that we live in. Not just you, we live in it too. And this is the decision you have to make. Do I pay a slightly higher interest rate, maybe some fees? Can I carry the $905 a month? Yes, I can. It's better than cutting a check to Revenue Canada by paying yourself more in personal income to get it qualified with a bank. So understand the numbers first before you decide on what to do. The self-employed borrower is going to get hit harder moving forward than years past. Let's sit down and we'll help walk you through the real numbers, okay? Thank you.